This is Macrovoices with hedge fund manager Erik Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. Macrovoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Erik Townsend and Patrick Ceresna.
Macrovoices episode 132 was recorded on September 13th, 2018. I'm Erik Townsend. Our all-star fall lineup continues this week with Charlie McElligott, who heads up cross-asset macro strategy for Nomura. As many of you know, Charlie's in-depth analysis of the knock-on effects of the vol complex blow-up in February got a huge amount of attention on institutional desks all around the industry, and Charlie was kind enough to put together a fantastic chart deck for this week's interview. I think you're going to really enjoy this one, folks. We'll also have an update for you on our efforts to plan another Macrovoices live event after the market wrap, and be sure to stay tuned for our post-game segment after the feature interview when Patrick and I will discuss Dalio's new book, which Macrovoices listeners can get for free using the special link in your Research Roundup email. Now, to let the truth be told, anybody can get it for free just by downloading it because it's a free book. But somehow that free offer for Macrovoices listeners sounded so good I couldn't resist.
And now I'm Patrick Ceresna. Now, Erik, let's jump right into this. The S&P 500, after having consolidated in what was just a very traditional, 50, 60-point pullback over the last couple of weeks, really the buy and dip traders just showed up right off that level that we talked about last week, that kind of 2870 level held the line. And it seems like right after those CPI numbers and after the ECB announcement, the market just went risk on, and we've ripped now and are trading very close to 29.10 at the time of recording. What's your feelings about the market here?
Not quite back up to that August 28th, 29th high, whatever the high was, but rapidly approaching it. And, from my perspective, the key point here is the bottom didn't fall out. Remember a week ago, everybody's saying, oh my God, September is here, the market crash is starting. It hasn't happened yet, and my gut says the final high isn't in yet. Doesn't feel to me like that. Usually when you hit the final top of a market, it's a one-time event. You hit a high and it reverses, never to be seen again. It doesn't feel like that to me. I think we're edging higher towards a breakout to yet another round of all-time highs. Could be wrong, but we'll see. But as far as any kind of precise tactical view, Charlie is the man. So let's hold the rest of equity commentary for the feature interview.
All right, well, let's move on to the dollar index, because one of the drivers of that kind of risk-on upswing was the fact that the dollar once again pulled back. Really did happen after that ECB announcement where the euro kind of gave that pop, the dollar came off, and, gold popped, the market popped, everything kind of moved. What's your feeling here? Is this just a short-term blip on the downside, or is there something more to read into this dollar move?
Well, as you say, this happened on news, and, it's not like the bottom fell out and the end of the world is nigh. We are below 95, daily close below 95. In fact, 2 daily closes in a row below 95. As I said last week, that's definitely cause for raised eyebrows. Now, I don't think that we've gotten down to the previous low from couple of weeks ago. So, I really don't think that it's time to conclude that it's all over here. I would say that it's not looking quite as strong as it did last week. The real number that I would be concerned with is if we saw that support that's been pretty consistent at 94. If we saw a daily close below 94, that would be reason for concern. Right now, though, I think it really goes back to what I said last week, which is, after Labor Day, this is the time when directions get set in markets. It is entirely possible that we're seeing a top and that we're going to start moving dramatically down on the dollar. We have not seen enough of an indication yet to yield that conclusion, but it's the time of year when it certainly makes sense to pay attention and be ready for anything to happen. My expectation, though, is I'm guessing that today's event was mostly a reaction to the inflation print and ECB, and that probably, this too shall pass. I'll be a lot more comfortable with my bullish view when we see daily closes above 95 again.
Eric, one thing that I was sort of thinking about in terms of the dollar, wouldn't it be interesting if the dollar just did a proper mean reverting retracement, which is that it kind of even drops down to the 93 handle, breaking a very key technical support where all the consolidation's been happening throughout the summer. A break like that could theoretically drive a true risk-on period where all those cyclical beaten down sectors rip higher and the stock market rips higher, and that could actually be the fuel that pushes that stock market to the peak. And then the real next meaningful rally in the dollar may truly be when things are unraveling and then the safe haven asset of the dollar becomes really relevant again. What do you think of that idea?
Well, I certainly think that if the dollar were to break all the way down to 93, say, that you're exactly right, that could be the impetus for stocks and gold and a bunch of other things to really take off. Would that be the impetus that then pushes a final high, and would the dollar then reverse after that final high? Well, now we're lining up quite a few dominoes in a row. So I don't really have a strong view, but I do agree with you that if we are to get several daily closes in a row below 94, I think that a lot of people are going to change their bullish view on the dollar, and people that have been waiting to buy gold are going to start buying gold. The stock market's going to be propelled higher. A lot of things could happen. Would that lead to a final blow-off? I'm not so sure.
Now, Eric, let's move on to crude oil. Let's start off with the inventories. How did things come in this week?
Crude oil drew down 5.3 million barrels, not quite as big as API had expected it to. Cushing drawing down 1.2 million barrels. Now, that's significant because what we've seen for the last couple of weeks is Cushing finally recovering, building inventory even in the face of nationwide drawdowns. That trend has changed, and furthermore, on Thursday, I saw a copy of a Genscape print, which is a private data survey, expecting Cushing to continue next week to fall even further in terms of inventory. Gasoline building 1.3 million barrels. Probably a good thing considering the hurricane that is about to hit the East Coast. Distillates building a massive 6.2 million barrels. Now, all of this resulted, at least immediately after the print, in crude oil trading up. But then by the time that Wednesday was over, it was back down to about where it was before the data came out. And sure enough, Thursday proved to be a pretty big down day. Frankly, I don't have a lot of explanation. There was a really big move down in crude oil at just about 10 minutes after 10 o'clock on Thursday morning, and I don't know exactly what the driver was for that particular move, but it took oil out and equities down with it. Equities recovered, oil didn't. So it remains to be seen what the driver is there. Production, meanwhile, ticked down to 10.9 million barrels. Now, remember that because they round to the nearest 100,000 barrels, this number doesn't really mean very much. But the point is, there was a pretty solid uptrend of production moving up. It's come back down a little bit. So it may be an anomaly in the data, maybe not. If we were to see it go all the way down to 10.8, another tick down, that would definitely cause me to think that maybe the recovery in the shale space is faltering. We'll see what happens.
All right, well, let's talk a bigger picture because I've sort of been looking for a crude oil topping formation. And in fact, WTI seems incredibly toppy. Almost every rally seems to be fizzling out, and overhead resistance at the 70, 72 seems pretty formidable. But then you look at Brent. I mean, there's $11 spread now between WTI and Brent actually on the charts looks actually very bullish. Something's got to give. You ain't going to have one blow out to new highs and the other one rolling over and selling. One of the two is going to be a false start. It's really hard to make it out. What's your thinking here on what's happening in the oil markets in the bigger picture?
Well, I agree with you on the false signals. It seems like Brent is bullish and WTI is bearish, and they can't stay that way for too long. The spread is already $10 wide. That certainly creates a lot of impetus for exports of U.S. oil. I expect U.S. exports to continue. As far as where is it going from here, I think that hurricane season in general creates a lot of uncertainty premium. Now, this particular storm, Florence, that's about to hit the Carolinas, it's pretty clear that it's missed the Gulf and the Gulf production, and it's missed the Gulf Coast refineries. But still, it's a major hurricane that's going to disrupt things on the East Coast. Perhaps more importantly, though, there's never been so many big storms building in the tropics at once. It looks like there's 3 or 4 more potential hurricanes. Still, some of them are hurricanes already. Some are tropical storms, but they're gathering steam in the Caribbean and in the tropics and maybe headed our way. That brings more uncertainty risk into the market, and I think that's one of the reasons that we've seen oil trying to push higher here for the last several days, as everybody's unsure as what's going to happen with Hurricane Florence and who knows what in the storms after that. I think once hurricane season is over, though, I'm kind of with you. It feels to me like we're looking at a topping pattern, even with this storm risk and other uncertainties in the system. We're not getting to a new cycle high above $75 or anything like that in WTI, and so it makes me think that, the market wants to find a top here, but I think maybe hurricane season has to play its course first.
All right, Eric, let's move on to gold, because initially gold got a pretty good surge on the fact that the dollar broke and the whole risk on, but it seems already here within less than 24 hours, we're almost all the way back down to 1,200. We're trading at 1,207 at the time. I think why can't the gold seem to get anything in the tank here?
Well, I think that the gold market is not very strong, and it sort of gives a false signal of looking like it strengthened up. Well, look at what happened to the dollar. Meanwhile, the last time that the dollar was down at these levels, we saw gold getting all the way up to what was the number, around 1220, 1221, something like that. Got down to the same level on the dollar, didn't get up as high on gold, and even with the dollar still at 94.5, we're looking at gold losing its steam here. So it feels to me like the gold market wants to roll over and move further to the downside when the dollar reverses and continues further higher. Now, that's assuming that my view is correct about the dollar, and that's what's going to happen. If the dollar breaks below 94, and especially if it keeps on dropping from there, I think that's when a lot of people who've been waiting on gold would maybe change their mind and say, okay, maybe it's over for the dollar. Maybe it is time to buy gold, and I think that would create a real impetus for more gold buying. But I don't see it until we get a clear sign that the dollar is dropping, and we don't have that sign yet, Patrick.
All right, well, let's move on to the 10-year Treasury yield, because we were slowly here ticking away, approaching at that 3% mark again. When the inflation print numbers came in earlier this morning on Thursday morning, they came lower than expected. I was initially thinking that low inflation, the inflation boogeyman that was messing with bonds could kind of subside, but really yields have not really changed much after that inflation number. We're still trading around like the 298 level here. What's your thinking on bonds?
Well, here we are again at the very top of the narrow range between 280 and 3%. And each time we've gotten right to the edge and we've said, okay, it looks like maybe we're starting to break past that 3% number, we end up just reversing back the other way. So I think for swing traders, it's time to start betting on the yield coming back down, which would be bullish on buying Treasury bonds. I don't plan to trade it myself. I think that there is a good possibility. And certainly, as I've said before, now that we're into the middle of September, it's time to watch for significant market directional trends to develop. And I think that it maybe is time that we should be looking for a breakout. But we got to get through 3% first, and we got to get through probably 3.10 after that before we can really say that the trend is on. So I'm still in hurry up and wait mode. I think it's time to pay close attention to this market. Daily closes above 3% in yield, and certainly above 3.10 would be a very important signals. But until they happen, I think it's hurry up and wait.
Thanks for the market update, Eric. But listen, before we move on to the feature interview, we have some housekeeping items. Many of our listeners are waiting to access the video presentations for the Macrovoices live in Toronto. What's the status there?
Finally, Patrick, 99% there. All 6 feature presentation videos are up and visible at macrovoices.com for people who've donated $50 or more to Macrovoices in 2018. Now, there is one more video coming, and it's a really good one. It's our town meeting where we had all 6 speakers on stage at once, and we had a group conversation with lots of questions and audience interaction. So that one is not up yet. It should be coming by the end of the weekend at the latest. It may even be up by the time that you hear this episode air on Thursday evening. Meanwhile, I just want to remind people that the way this works is you log in using your username and password. Once you're there, on the black menu bar at the top of the screen at macrovoices.com, you click where it says Macrovoices Live Videos. We've had several emails from people who don't seem to be able to find that button. It's right under the Macrovoices logo at the top of the page.
And since our Toronto event was such a roaring success, what about organizing another live event?
Patrick, we've got George and Kathy, our volunteer event organizers, working away on this, but we absolutely need your help, folks. If there is any chance that you may want to attend our next event, we need you to take a survey at macrovoices.com/survey. This is not just to get your wishes. So those of you who are thinking, I'm sure it'll be fine, I'll just wait till it's announced and I'll sign up then. No, look, we need to know how many people want to come because George can't negotiate with the hotel in order to secure event space until we get an idea of how big this thing is. The problem that we have is that in Toronto, we sold out in 10 days. We cut things off. We know that we've got about 75 people who are ready to jump on a plane and fly across the country or even across the world in some cases to come to it. What's the total audience? Have we not sold out? Is it 80 people or is it 800 people? We have no idea. And until we figure it out, we can't really negotiate with the hotel. The concept that we're thinking about is a longer conference. We've tried to be driven entirely by participant feedback on the survey that we did from Toronto. We're thinking Las Vegas. We're thinking around February. We're thinking 2.5 to 3 days. Lots of speakers, some of the very best interview names that we have at Macrovoices. And we're thinking about introducing a new VIP pass concept, which would give you much more personalized access to the speakers. We'd be seating you at meals with the speakers and creating other opportunities for more personalized interaction. There's a lot more information at macrovoices.com/survey. I don't want to take a lot of time for those listeners who are not interested to not have to listen to this. So please, if you have any interest, go to macrovoices.com/survey. Take our survey. Let us know what your interest is, whether you're interested in the VIP option. Once we have that information, we'll be able to proceed with our planning, and we'll give you an update on future shows as to where we're headed.
Also, Eric, our listeners can also find the link to that survey in that Research Roundup email we send every week, and we'll probably keep it in the email for several weeks in a row. So please, if you're listening to this and you open up one of you'll find that survey in the email. So now that survey pertains exclusively to the multi-day event. We're considering Las Vegas or one of these other warmer weather cities in the winter. But what about the separate question in regards to Macrovoices event that we were thinking about doing at the Natural Resource Investment Conference in Vancouver, Canada, out in January?
So that one is not our event. We're not producing that conference. The thought was, since we have a lot of listeners in Vancouver and you and I have been invited to speak at that conference, maybe we should do some kind of Macrovoices event on the side. We're struggling to decide. Should we just do a party, like get a restaurant and rent a room and have a few beers with Macrovoices listeners, or should we actually add some kind of presentation or something to it? We're not sure. So for people that are interested, it's January 20th, 21st. What we would be doing is selling you some kind of ticket that includes your admission to the Natural Resource Conference, which has got all kinds of big-name speakers. Rick Rule's going to be there, Jim Rickards, a whole bunch of big-name people will be at that conference. Again, that's not our event, but we would organize a Macrovoices get-together separate from that. Let us know if you want to go, because we need a head count, and also let us know, do you want us to just organize a get-together, or do you want us to put some kind of presentation together? And if the latter, what subjects interest you the most?
And those of you that want to let us know, make sure you email it to us at info@macrovoices.com. Now, this week's featured interview guest is Charlie McElligott, who heads up the cross-asset macro strategy at Nomura. Eric's interview with Charlie McElligott is coming up as Macrovoices continues right here at macrovoices.com.
And now with this week's special guest, here's hedge fund manager Erik Townsend.
Joining me next on the program is Charlie McElligott, who heads up cross-asset macro strategy at Nomura. Charlie has put together a fantastic slide deck to accompany this conversation, so please download it. Listeners, you'll find the download link in your Research Roundup email. Charlie, for people who have been following your writing since you joined Nomura in January, I remember the first piece that I saw that really got my attention was where you described this perfect storm after the VIX complex blew up. And you said, look, if we get to certain levels on the S&P, it's going to trigger the commodity trading advisors. They're going to start systematic selling. It's going to unleash a whole bunch of things. And fortunately, we never got to that level. But I was very impressed with your analysis. And as I've followed your work since then, I noticed that although you tend to be writing about the here and now because that's the way institutional research is structured, I'm able to assimilate kind of a framework, if you will, that seems to guide your thinking, which I've pulled together from reading several of your pieces. Can we try to present to our listeners a summary of that framework, how you think about markets and how this all fits together? And from there, I want to go into much more detail on your slide deck and a number of other questions.
Absolutely. And I appreciate the opportunity to be here, Erik. It's a great program. I would say that the way that I approach the job with regards to assessing kind of the cross-asset macro landscape from a high frequency, meaning a more of a closer to the net end user, the net end trade, idea-driven approach, as opposed to a research, deep analytic dive, kind of slower moving, is that because in the post-financial crisis world, trade time horizons, macro regime shifts, factor rotations, systematic leveraging, deleveraging are a permanent part of our landscape. So what I need to do then is I need to have a kind of medium to longer term 6 to 12 month view on where we're looking while still having a day by day, kind of directional call, favorite trades, worldview, where are the pressure points, where could things go wrong, where is consensus, and where are the asymmetries there when crowding can tip over. So with that said, as I started here at Nomura back late January, right before the vol event, I kind of saw this framework that I called a two-speed world thesis. And mind you, as I got back in my seat in January after my my non-compete gardening leave time, what I saw was immediate. As I mentioned earlier, the importance of systematic strategies, vol control strategies, risk parity, of course, trend following, CTA. Those are a critical part of what it is that I do on a daily basis, certainly based within a very vol-centric world, because the changes, the inflections that are made happen unemotionally and happen with significant leverage behind them. And what I saw when I immediately came in and kind of was reassessing the world at the time was that the most crowded trade in the world, kind of long FANG tech at that time, was that there was an implicit short dollar trade in almost every macro trade that we look at across both our risk parity and CTA models. That was, certainly there was a max long equities worldview, obviously large cap equities, certainly tech, NASDAQ, which benefits from those overseas revenues. But then also, too, there was a huge bearish rates trade as people set into the year. There was massive length in euro and yen on the view that policy was going to reconverge, right? This idea that we're hitting kind of this dual growth. So as opposed to the prior 2 years where it was just U.S. at economic escape velocity and rest of world behind, everybody got really bulled up on the prospects for Europe, for Japan, for emerging markets, for the rest of the world to play catch up. And with the twin deficits within the U.S., this very bearish U.S. dollar view began. People were max long crude, max long commodities. It was a pretty consistent theme. When I see something that consensually embraced, and certainly within the systematic leverage community, the trend community, coming off a year like 2017 where being long S&P was a 4 Sharpe ratio trade, my warning signs were up. Promptly, we had the equity vol event, which I joked to clients. We all knew what was happening within the leveraged VIX ETN complex. We knew that those daily rebalancing, the daily Vega rebalancing at the end of day was going to tip over at some point. I called it a neon swan for a long time, but something set that off. And what, in my mind, set that off was if you went back to December, you had the first passage of tax reform bill in the Senate. And shortly thereafter, in the start of December, you had the cyclical bottom in U.S. Treasury term premium, basically interest rate volatility risk. And I think what that spoke to was that we were late cycle and the economy was already at breakout speeds at that point. Now we're adding gasoline to this fire, and effectively within the next month, we also got this dual fiscal stimulus of the deficit spend. And what that did, when Treasury term premium bottomed, the entire cross-asset volatility world also pivoted and broke higher after that point. So in my mind, that moment when the forward-looking path for interest rates became clouded for investors across the world, across multiple asset classes, you no longer knew that late in the cycle, adding on dual fiscal stimulus, what that was going to do with regards to central bank policy, with regards to inflation. That's where the kind of the rolling volatility events of this new regime took place. So within a week of that, you had the peak in S&P one-year forward earnings estimates. You had that same week the peak in cryptocurrencies. Within a few weeks, you saw the tights in credit spreads, right? In January, you had a spot-up, VIX-up environment across the equities complex where you had that massive risk rally within stocks, but at the same time, VIX was trading up, which is a precursor, one of those moments where, sitting on a vol desk, you're anticipating some sort of crashy, wingy type of event. There was a number of indicators in that 2-month period that something had inflected. So to take it back to that larger 2-speed year thesis, the first phase was what I call the cyclical melt-up phase, which was classic late cycle, where the economy in its current shape with the enhanced expectations, the animal spirits of the tax cut, the animal spirits of the deficit spending, you typically see commodities and inflation-centric, high beta assets outperform. So my view at that time was, you want to be within the rate space. You want to be long tips, short nominals, long break evens, right? You want to be bearish fixed income in general from the kind of U.S. Treasury side. And on the equity side, you want to be long cyclicals, right? The stuff that works that frankly some of which had been left for dead for a long period of time. The stuff that gears when you have, interest rates moving higher from real growth. So, financials, materials, energy, industrials, those deep cyclical types of sectors. And that's exactly what we got over those next 6 months. You had very consistent, pretty high Sharpe ratio, even with the volatility event in February and some disruptions thereafter in the coming months. These trades kept generating returns. In June, to fast forward, May and June, I started seeing some signals that there was this shift developing into my phase 2, right? And my phase 2 was what I call the financial conditions tightening tantrum phase. And from that, this was basically a transition from a very directional, long risk, long inflation, long cyclicals, bearish fixed income type of view to a much more difficult tactical phase, right? Where trading windows, time horizons on trades were going to be multi-week, every month, kind of powerful reversals, market neutral trades to protect yourself, seeing, relative value, sector selection really take precedent. And in mid-June, I sent out a note talking about this downshift and that it was time to get tactical. And, I think it makes sense probably to go over some of those indicators that I saw at the time that frankly signaled to me that we were transitioning out of this smooth sailing phase into this very late cycle and effectively pre-recession phase.
Well, and as we are now recording this interview in September, I think of September as a very important month because, the big boys are back from the Hamptons, the big decision makers on the desk. It's maybe time for something to happen. I think you've written recently about 2 flavors of September. So I'm curious, what do you watch for? Where is September? What are the possibilities of where it might take us? And how does that fit into your phase 2, everything's changing, market tantrum scenario as far as what we might expect in Q4?
Absolutely. When I speak to those things that started inflecting in June, what ended up really happening too was that the status quo momentum types of trades that had been driving performance for the last 1 to 2 year period, frankly, started coming a little bit unglued, right? Whether it was, bouts of extreme reversals in equities growth versus value, where suddenly value would start ripping over growth, or that period of cyclical outperformance over defenses would start reversing. Those were generating signals of performance pain, right? So for the next kind of in that June, July, August window, some of the most acute drawdowns within the hedge fund communities, whether it was more within the equities community, but also too parts of the macro community, were giving back their entire year's performance in a matter of weeks to months. And that is a signal. I monitor performance very closely, the same way I monitor positioning and kind of sentiment and where consensus is. And when you start seeing those types of reversals, right, where crowded shorts are outperforming longs, momentum unwinds, you started seeing from a macroeconomic perspective, Treasuries rallying on strong inflation data, it told me that there was some sort of macro regime shift happening. So that big performance drawdown painfully set up a call that I made in the beginning of August, that looking at the seasonality of equity factor performance, that there was going to be a huge momentum rally, right? Which is a perverse dynamic after you've had such a drawdown. I mean, there was, a number of very large funds that lost anywhere from 6 to 8, 9, even 10% in a few, say 5 to 8 week period there, that playing the seasonality of September, and September is dating back to 1984, the second best month of performance for a momentum factor strategy. And a momentum strategy is very simple, right? You look at the Russell 1000, you take the top decile of performance names over the last 1 year period from a price return perspective, and you go short the bottom decile. And this is the FAMA and French stuff that's, been so documented with regards to, what are the actual drivers of equities. You can rationalize why does September see such a momentum outperformance, which of course would be this big, massive pain trade for so many funds that had grossed down their positions, meaning that all those macro regime signals that I was speaking about in kind of the June, July, August period, where crowded growth names, tech, FANG started coming unglued, and the underweights, the shorts in value sectors started squeezing higher. That means that funds were grossing down. So they were covering their shorts and selling down their longs. That's a classic de-risking reality when you're the shoulder tap, right? You had an environment where people had grossed down and or taken their net exposure down, so just either by selling their longs or growing their short books, thinking that the market was at risk. And there was a lot of growing skepticism and pessimism over the course of the summer, obviously around the rolling volatility events within the emerging markets complex. Commodities were down 10% plus from their earlier in the year peak. The developed markets within Europe, around Italy, there was a lot of bearish stuff going on, and a lot of it tied into the escalating trade tensions, that there was this kindling basically for a massive rally. And the September rationale is very simple. Momentum works as fund managers window dress. So at the end of every quarter, what many fund managers have done is that you add to the stocks that have worked when your investor letter goes out, your filing goes out to your investors, and you sell down the names that haven't worked because you don't want to look like a clown. And particularly in September, then, this phenomenon really escalates because in September, you start getting a number of very prominent mutual fund year ends. Both the September and October window are the vast majority of mutual fund year ends. It's not actually calendar. So that kind of accelerates that tax loss selling component on the momentum short side. And on the momentum long side, people are, window dressing. They're marking up. They're buying stuff that's worked. So over the course of August, exactly what I spoke about played out. Massive rally, 10% rally in the momentum long short, momentum market neutral strategy, which just really crushed both the hedge fund and mutual fund community. September now has an incredibly distinct seasonality dating back well over 30 years, is that you actually see people get back to work. It's conference season. They're getting, investors, PMs, CIOs are getting ready for the earnings season that kicks off in October. there's kind of a refocusing, there's an optimism in the air, and you see the first 2 weeks after Labor Day, the market slowly grind higher. Then the back half of the month, almost like the 15th to a T, you begin to see risk come off. You begin to see defensives outperform cyclicals, which of course, again, is a pain trade, right? That's not how people are set up in the current worldview. And so you have this dynamic where the back half of the month you fade. And I think, frankly, a lot of that is tied both into September expiration, where you have, a lot of dealer gamma rolling off, and as well into the October earnings season, you see the two of the three biggest buyback sectors being tech and being financials. Those folks begin to enter their blackout windows. So we all understand the dynamic that, in the quantitative easing period, that you've incentivized corporate malinvestment, bringing debt for free, basically, to buy back stock and strike your options, and makes your shareholders happy and makes the C-suite happy. That buyback virtuous cycle has not stopped, and frankly, after the tax reform package, has only accelerated with the repatriation of those dollars. Most of that has gone to buying back stock. You hit the blackout window, you have a downdraft in the equities market in September. So we put the momentum trade on in August, it crushed it. Now I've taken off the long momentum side, and I'm just keeping the short momentum trade on for the back half into then what I expect to be another powerful rally kind of starting in October, largely, again, driven by this performance chase phenomenon, because funds have just so massively underperformed index and benchmark over the last 3 months that now you're in career preservation mode as you push kind of in through Q3 into Q4, and people will start grabbing at the market again, especially around earnings season, where it's kind of a well-documented phenomenon where managers put on their blinders, put on their macro blinders. They tune out the emerging market stuff. They get very into the health of the balance sheet, the earnings growth story, the scale of the buyback, and typically that's a constructive environment for equities. From there, I can go in a lot of different directions, but what it speaks to is that almost without a doubt, on a 1 month basis, you have these entirely different trading environments, entirely different regime changes. Just as the same way as you went from this kind of June, July downdraft in risk, and then you had this huge momentum re-risking in August ahead of the September seasonality, and September then has two different feels. October is going to have a big risk melt-up move into actually a macro phenomenon that I think is going to be a very powerful negative force, a quantitative tightening impulse, that where the three largest central banks in the world, ex the PBOC, are all going to be quantitatively tightening. The U.S. Fed SOMA account, the Fed balance sheet runoff, escalates to the $50 billion a month max. At that same time, the ECB's bond purchases taper in half starting in October. And then the BOJ, who recently moved their yield curve control range up, that's effectively going to create a further stealth tapering, because you simply don't need to buy as many bonds and potentially as many equity ETFs, because of that yield range gives you more flexibility on volatility. So I think you could actually have the potential for another potential interest rate shock that, risk assets obviously do not tend to like, as we experienced back in the January, February period.
Charlie, why don't we go ahead and jump into your slide deck? It's pretty darn clear here from page 2 in the deck that ED5-9 is almost at the low point in terms of where its cyclical lows have been. That part's clear. What may not be clear to some of our listeners is what the heck is ED5-9?
So the Eurodollars curve is a way to trade short-term interest rates, or Eurodollars, that is. And it's not the currency, but it's talking about U.S. interest rates futures. And what is important here is these, again, so often we quote the yield curve from a 2-year, 10-year, or a 5-year, 30-year basis, which have absolute value, right? There's a long-term view with regards to economic sentiment, inflation, Fed policy contained therein. But what's so important about the short-term interest rates and these spreads or these curves is that it's giving us, a much more real-time kind of prognostication tool with regards to where the market thinks the Fed is nearing the end of this normalization cycle. And the end of this normalization cycle is critical for the kind of culmination of this phase one transition from the cyclical melt-up phase into the phase two financial conditions tightening tantrum phase that is going to have major implications for cross-asset universe and fund performance.
And moving on to slide number 3, what are we looking at here?
So slide number 3 is telling a story that is picking up within a macro factor PCA model that I use as part of my framework, where what we are beginning to see then is that same phenomenon that the slide 2 was showing, which is that as that curve inverts, and that's looking out a year to 2 years from now, then inversion there means that the market is now believing that somewhere within that time period, looking out 1 year to 2 years, that the Fed is going to stop hiking, and it's now more likely that there's a slight easing. And why that's important is that gives us a goalpost. And on slide 3, my macro factor PCA model is showing that the equities complex is now registering that tighter financial conditions are now having a negative impact on S&P, meaning stocks, U.S. equities, are now picking up on this very late cycle nature of where we are picking up on this tighter financial conditions phenomenon that I'm speaking to. And in this particular slide, it's showing that the U.S. dollar, which is maybe the most important financial conditions, measure of them all, is now a higher dollar is now a negative for stocks. And that is important because, as you can see, just recently, as of this summer, we were at year plus positive correlation between the dollar and U.S. stocks. And my rationalization of that is because the U.S. at that time was this lone beacon of growth in the world, right? So investors wanted to be long U.S. assets. Crude's bounced at that time, and the fact that the U.S. is now on pace to be the largest exporter of crude in the world, long dollar is a very pro-cyclical, pro-U.S. economic indication. Now the data is showing us in our macro factor PCA model that a stronger dollar is now officially a headwind because it tightens global financial conditions.
And is that a prognostication that the dollar rally is about to end, or does it mean that it's going to continue, but it's going to be bad for stocks and look out below for equity markets?
Well, I think that there is, and frankly, this touches on slide 4 as well, where it's also the same tool that we use looking at the 2 other main indicators that I use to assess financial conditions. You see both inflation expectations, which for the last 2-year period have been massive positive U.S. equities drivers, have now 2 inflected negative, as well as global real rates. And real rates are nominal interest rates that you are actually including as well, an inflation outlook in as well. So real rates are a kind of the purest indication of financial conditions tightening. And right now we have all 3 of these things moving higher in unison. And that's why that this is now confirming to me that incremental moves higher in the dollar from here are going to be perceived as pretty powerful risk asset negatives. And frankly, by the time that affects what the Fed is going to end up doing, whether or not that means that they say sometime in 2019 reduce the number of hikes that they currently have planned, the curve will steepen. And by the time the U.S. Treasury curve steepens, that's when equities begin to sell off.
And as we move on to slide 5, it looks like we can expect tightening conditions across the board in all sorts of different measures of short-term credit cost.
Right, exactly. I mean, the key here is I just wanted to highlight those 2 boxes that we're back at 2008 levels, of tighter financial conditions. That's looking at, kind of 3-month T-bill, right? The ultimate kind of cash equivalent, LIBOR as obviously the cost of money, U.S. aggregate credit yield to worst, grinding back to kind of 2009 levels, commercial paper, right? This is the stuff that lubricates the financial system, general collateral repo on the bottom. That's the stuff that makes the system work, that funds businesses. It's critical to keep moving. That's simply higher yields on that stuff, higher interest rates on that stuff, slows down the velocity of money. And that's ultimately pure financial conditions tightening.
We've had a lot of conversation on this program about the risk that's created by the massive credit expansion that has occurred in China since 2009. What is slide 6 telling us here?
So it's an interesting slide that I reference a lot. I have so many requests to, hey, can I see the updated Chinese credit financing impulse framework? Because it tells a story. It flows down. But what you can see in that top panel is that the Chinese credit impulse, which is basically the 12-month change in new credit as a percentage of GDP, has now moved sharply negative, and back to levels last seen 4+ years ago. And what is key there is that this comes off the back of something that we're all very cognizant of right now, certainly as it pertains to these occasional global growth scares, certainly the EM wobble right now, the emerging markets wobble right now, is that over the last 2-year period, the Chinese, knowing that they have a debt bubble on their hands, a credit bubble on their hands, as they try to transition their economy to a service-based economy from a commodity-centric manufacturing one, have tried to rein in, the kind of aggregate social financing, have tried to begin deleveraging movements, have tried to begin controlling the shadow banking system. And ultimately what that's done is, they've created tighter conditions there as well. So as that credit impulse, right, these new loans that are being forced out to banks per quota, those asks from the PBOC and from the central planners have eased. What ends up happening is that in that second panel, all system liquidity then slows as well. There's a seasonality. There's a very powerful seasonality with Chinese credit impulse, Chinese financing, certainly into their new year at the start of the year. There's a huge impulse to feed that multi-week shutdown, and then you kind of taper off from there. What ends up happening, though, is that you're seeing under this deleveraging regime a diminishing magnitude of these impulses. And all of those kind of middle panels lower show what the diminishing magnitude of that credit impulse has on Chinese financial conditions. Meaning, in that fourth panel, Chinese financial conditions moving lower, that means tighter financial conditions. The next panel speaks to Chinese inflation surprise index trailing lower. You see these peaks and then these fades. And the yellow line is that global inflation surprises, meaning is inflation data, CPI or CPI core data around the world, beating or missing? On average, those are missing now, those global inflation. China is the engine that drives global inflation is what I'm communicating here. From there, that blue line is U.S. Economic Surprise Index. You see it correlate with those credit impulse dryings, those credit contractions. You see our own Economic Surprise Index contract significantly, where currently we're actually still negative, meaning we're missing more on average. And the ultimate cyclical indications, industrial metals or equities, cyclicals versus defensives, follow that exact same pattern. And why this is all very important right now, obviously there's been a ton of press on this, and I think it's a little bit noisy, but is the scale of the, within the leveraged fund community, certainly macro funds, absolutely the CTA side of things, trend followers, is that there's a huge short in treasuries, right? And the huge short in treasuries is based on inflation escape velocity, but you have this drying of the Chinese credit impulse that's actually creating a disinflationary impulse, especially with the yuan depreciation, and that is risking, of course, potentially, significant short squeeze in the U.S. Treasury space.
Moving on to slide number 7, I know because I have a home on the coast of Maine for sale, and the realtor tells me it's past peak in the cycle. Don't expect great prices for a while now. Looks like you're seeing both home and autos telling you the same thing. What's going on here?
Again, I think context is important when you look at prior cycles, prior recessions, and what I want to communicate here is that by the time that the Fed has stopped hiking in the kind of months and 1 or 2 years prior, you've seen near-term peaks in the auto sector and the homebuilder sector. And that makes sense, right? This is very rational. These are incredibly interest rate sensitive parts of the economy. And those sectors in particular begin to pick up on this fact, right? I mean, if it's simple, say after a Fed hike, there's an initial impulse that then creates, higher mortgage rates, that then creates buyers to kind of move to market. Got to get off the pot and transact in this house. Well, you got that, and now you're fading. And obviously part of this story here, too, is inflation. There's inflation and the tariffs and building products and things like that, and this current more steeper fade in the home builder space. But these are large purchases, right? These are large purchases, 30-year mortgages, large auto loans. They're very interest rate sensitive, and both of these sectors are incredibly cyclical and pick up on this late cycle shift. Back to that bottom panel is telling me that we are probably nearing the end of the Fed's hiking cycle. My major message here is that I think there's an increasing likelihood that 2019, even though the Fed is currently telling us, they're projecting 3 hikes, the market is only pricing in 44 bips of hikes versus the Fed's 75 bips, that there's an increasing likelihood that the Fed might have to pause, if not never get to those 3 hikes. And this is just another kind of signal that we are very late in the process.
And I see on page 8 you're looking at a comparison going back to 2003 through 2008. What's the story on this particular chart?
I think it's kind of a narrative clarification where you see it every day in financial media. I've spoken about it too, how important the inversion is as a signal. The yield curve inversion is as a signal. But I think what people are kind of missing a point there. This signal is telling us that we are transitioning, right? But what you need to, as say, an equities investor, is realize that it's when the curve steepens, that's the moment when equities come off. So you can see here in early 2007, the yield curve began to steepen. If you recall, early 2007, before the mortgage crisis was, that's just when you started seeing the signals, right? I think in January or February, you had HSBC pre-announce on their, mortgage portfolio. By the summer, you had the Bear Stearns structured leveraged credit hedge funds blow up. You started seeing the yield curve steepen because you began to pick up on the fact that the Fed's hiking cycle had paused and was nearing an end, right? That's the top white line there. And the curve steepening accelerated because what happened was the market began to remove hikes from their projections. And what that does is that the front end rallies massively, yields move lower in the front end, the curve steepens, and that's when that blue line, the same time that the Fed began cutting, it was too late, and equities sold off and equities were smoked while the curve continued to steepen. So it's when the curve steepens that equities investors need to be afraid. And, I think that's why one of the most popular trades we've done all year for clients have been these curve cap options. They're constant maturity swaps, but basically it's a very simple tool that lets you bet on the direction of the curve. And what people are doing are putting on these 1-year or 2-year expiry steepening trades via these options, with a defined P&L and timeline that are huge risk-off hedges. We've been putting them on in massive size for macro funds, for credit crossover funds, for equities funds, because ultimately the takeaway here is that the curve steepener is the risk-off move. When the curve begins to steepen, that's when the market smells the slowdown, smells that the Fed is done, smells that the financial conditions tightening has negatively impacted or is beginning to negatively impact the real economy, and that's when you have the risk-off move.
Moving on to slide 9, it looks like even more late cycle indications.
Yes, slides 9 through 14 are just a number of metrics that I look for a signal in. And you can see the pressure building on the Fed with regards to, and I'm just looking at a couple of Dallas Fed metrics here in particular on slide 9, but with the idea of that inflation is finally percolating and is here, whether it's wage inflation, wage outlook at 11-year highs, prices received at 7-year highs, prices paid for raw materials, 7-year highs. Those are speaking to the really difficult position that the Fed is now in. Tomorrow's CPI number is going to be massive in that sense because it's either going to tie their hands or it's going to allow the Goldilocks environment to continue. And slide 10 is similar. More that price is paid. You're talking cycle highs since the financial crisis. This is classic pre-recession behavior. The next slide on 11, the wage surveys, expectations for wages, you're at cycle highs, and frankly, you're back to secular highs at these current levels. Again, a useful indicator that we're entering that pre-recession phase. Slide 12, the U rate, obviously with a 3 handle now, these typically max out in late cycle pre-recession phase as the economy overheats. You can't find employers. We hear about it every day in the front of the newspaper. Employers are having a difficult time hiring. That creates a drag. So that's very consistent. Then on 13, this actually goes back to that cyclical melt-up phase, right? You have crude as a tell for this late cycle inflation. When the economy is overheating, you see these significant crude rallies. So back in the early 90s, 131% move in crude. In the late 99 move into the internet bubble burst, you had 120% move. In the pre-financial crisis phase, a 230% move. Right now, we're nearing a 90% move in crude. So that's also beginning to rhyme. And then finally, this is a pretty unique one, but one that I love. It's consumer confidence expectations minus the present conditions. And it speaks to this tremendous overshoot of confidence. And you see these kind of cycle lows where we currently sit as a great tell on pre-recession period coming soon.
Now, since you mentioned tomorrow's CPI print, I should mention for our listeners, we're recording this interview Wednesday afternoon, which means we don't know Thursday's CPI print or the outcome of the ECB press conference, also scheduled for Thursday, just to make sure our listeners are aware of where we are. Moving on to slide 15, it says a lot of really, really rough times for equity hedge funds. What is causing this underperformance for equity hedge funds?
Eric, I think it's the purest example of the regime change catching folks flat-footed. It goes back to that transition window. You can see where the drag really started in, kind of mid-July, this idea that we're moving from quantitative easing to quantitative tightening. And what that does is create, and as the term premium bottomed, you've had these rolling volatility events in emerging markets. You've had flash crashes in BTPs and U.S. Treasuries. This is an environment where it began to then play out, as I spoke to in June when I made that downshift note, where I started taking off those very pro-inflation, long directional risk trades and moved into defensives over cyclicals, moved into value over growth, which is a huge status quo momentum reversal. That's exactly what happened. Hedge funds got caught in legacy positioning and began to get crushed for it. In mid-August, when I put on that long momentum, kind of perverse rally that I spoke to earlier, that's exactly what you saw. You saw some relief because the growth stuff began to work again into that seasonal phenomenon of momentum performance in September. Now, because that trade worked so well, it returned 10% in a month, you're seeing performance fade again while the tape continues to hold. So it's just been an extraordinary period of reversal, and most importantly, almost in a month by month or 2 weeks by 2 weeks, kind of swinging from one side to the other, that has just made it very, very difficult for the average manager to perform.
Moving on to slide 16, it looks like even more indications of reversals.
Exactly, Eric. This is just a factor monitor and a U.S. equities factor monitor that I look at that just captures that these kind of rolling reversals that are very performance negative for folks, where you have all this stuff in that second to on the far right, second to last column, all the year-to-date performance sharply reversing in the short term. And that just speaks to, as you said, it's picking up quantitatively the phenomenon that is this macro regime shift to tighter financial conditions. The next slide, you just see hedge funds grabbing at market exposure, which speaks to their performance undershoot, right? Speaks to the fact they've had a hard time making money, so now they're grabbing at the market, which again kind of makes me a little bit uncomfortable for the setup, and I think sets up nicely for a pullback in the end of October. Slide 18, same way. You see it's capturing some of these quant momentum unwinds, and you can too see on slide 19 just equity long-short hedge funds, really struggling into what you capture on slide 20, which is this kind of herky-jerky seasonality. And after that, it's more of the same. Crowded trades are at risk of tipping over. And ultimately, the jewel trade is going to be 2019 when the yield curve steepens and you begin to see U.S. value stocks, which have suffered post-crisis period, begin to outperform growth. That's the trade that every fund in the world is scared of missing. But if you're early, it's killed your performance. So a lot of this stuff is really just capturing the current environment and picking up on the fact that the game is real time changing from where we've been the last 10 years.
Why don't we leave it there in terms of the slide deck, because we've only got a couple minutes left, and I'd like to end with the big picture. With all these things together, it seems like there's just every place you look, there's another sign that we're at the end of the cycle, that maybe it's not over yet, but we're getting close. Where does that leave you in terms of outlook? We've had some people say, look, this is it, the bull market's over, it's time to expect a major reversal. Other people are saying, hey, wait a minute, do not discount that possibility of one more melt up to a blow off top before it's finally over. Where do you think we're headed? What's your best guess as to what we can expect for the rest of 2018 and into 2019?
So as per the message in that downshift note that I sent mid-June, it's the same view. You have to be completely tactical. You can't just be lazy long, and certainly can't be lazy short right now, because yes, I do agree. I think that probably into the December Fed hike, which could be, one of the final hikes. Some people say it might be the last hike, in all honesty. I think we print probably cycle highs for stocks. Incredibly, between now and then, I think there's probably, 3 or 4 different directional trades, as I referenced earlier. I think, right now you're getting ready for that back half of September pullback in risk, which again is related very much to dealer gamma runoff around expiration, as well as the buyback blackout for financials and tech sectors. And then that sets up into earnings season in the macro blinders trade, higher equities, and probably a really powerful grab. And frankly, one that I'm interested in playing with, probably an emerging markets long, because it's been so distressed at this point. We've started seeing some upside option trades going through a pretty good size, and EEM, EWZ, FXI. I think that people are getting ready for that potential upside move into October. And then, as I mentioned, the potential for a risk negative impulse in the end of October and beginning of November, not related to U.S. midterm elections as much as some people want to talk about that, but more with regards to that quantitative tightening impulse that I spoke to earlier, where the Fed, the ECB, and the BOJ are all tapering asset purchases or their balance sheets. And with that, I think you could have an unruly move higher in interest rates that the cross-asset or risk asset universe doesn't like. So, again, almost on a monthly, biweekly basis, you're going to be in a different regime, long, short again, and then long rip into what I think will be highs into one of the last hikes of the cycle in December.
Well, Charlie, I want to thank you for a fantastic interview. It is no surprise that you have gotten so much attention since joining Nomura in January. For our institutional listeners who do use institutional research, please tell them where they can contact you, where they can find out more about the work and the research that you have on offer.
Sure. As it's a product of global markets, off the trading desk, if you are covered by Nomura within the global markets business, whether that's fixed income, rates, credit, FX, or the equity derivatives space, just contact your salesperson, and we're happy to begin that dialogue. Use the daily piece as a conversation starter and go from there.
Fantastic. And for our retail audience, you just have to keep, needless to say, Zero Hedge has been all over your writing since you joined Nomura, and we look forward to having you back here on Macrovoices at some point in the future. Meanwhile, Patrick Ceresna and I will be back as Macrovoices continues right here at macrovoices.com.
Macrovoices is a listener-driven program. Please email requests for specific future interview guests to requests@macrovoices.com. You can email questions for the program to mailbag@macrovoices.com, and we'll answer them on the air from time to time in our mailbag segment. We also welcome your suggestions for how we can improve the program. Now, back to your hosts, Erik Townsend and Patrick Ceresna.
Erik, what a great interview with Charlie. Now, personally, I'm a big fan of macro cross-asset quant analysts. The three of them that I enjoy the most is Charlie, also Marco Kolanovic at JP Morgan and Michael Hartnett at Bank of America. So this week's show was near and dear to my heart, as I always like to approach the markets in a similar manner that they do. It was interesting to me that his narrative was that there was going to be a very volatile fourth quarter with multiple tradable swings, both higher and lower. And this generally fits well with, as a technician, to the storyline of a bigger topping formation, because usually at the tail end of a major bull market begins a period where this beautiful bull trend starts meeting heavy supply. And so every rally is met with heavy distribution, but it's not ready to begin heavily selling to the downside. It's a lot different than what we experienced back in January, because that vol event created an almost immediate crash to the downside on the markets. But I think this time it will be a little bit choppier in trying to catch the turn point in this market. Anyway, what did you take away from the interview?
Well, Patrick, it's interesting you say that, because I had a very similar reaction. The thing that really speaks to me about Charlie's style, and I noticed it in that first piece that he wrote in February after the vol complex blew up, is, everybody else in the industry, they just look at either fundamental analysis or technical analysis. It's the old school stuff. Charlie's not looking just at that. He's looking at the cause and effect of, okay, folks, if we get to such and such a level on the S&P, it's going to cause the commodity trading advisors that are all running algorithmic strategies. It's going to trigger a sell signal, and that's going to cause them to do this and this. And when they do, that's going to cause so-and-so to do that and that. And this sets up this vicious cycle, which could lead to this, that, and the other thing. On the other hand, if it goes this way, these people are going to do this, and those people are going to do that. He's very in touch with what the real drivers in the market are, which is what the big funds are doing, what the algorithmic traders are doing. And he's got a very good sense of what the trigger events are going to be that could cause a series of knock-on effects to occur. So it's a style of analysis that I just have tremendous respect for, and I really felt this was one of our better interviews that we've done on the show. The other thing, though, Patrick, that really spoke to me this week was Ray Dalio's interview on CNBC. And we've got a link to that interview, or the video of that interview, on the Research Roundup email. And, I don't know Ray Dalio personally. I wish that I did. I have a tremendous amount of respect for him. But reading between the lines in that interview, I noticed something. First thing, the book is free. He's in philanthropist mode. Why is Ray Dalio, whose entire life has been about making money in markets, suddenly giving away things for free? And if you listen to the way he speaks, if you can get him to speak without the CNBC hosts interrupting him in mid-sentence, what he was trying to say is, maybe this is not a bigger financial crisis than 2008 for financial markets, but Ray is very concerned that for Main Street, for average American citizens, that we could be headed for a situation that's really, really ugly. And I think that what he sees in markets, and I agree with him, is that, in many ways, Ben Bernanke pulled a rabbit out of a hat and delivered a miracle with quantitative easing and so forth. But it was a miracle for Wall Street. It completely saved the $1 million banker bonuses and all that. It didn't do that much for Main Street. It did get the economy restarted again. But we shot our wad. We don't have enough resource now the next time that we get into a crisis to deal with what's likely to be much deeper social problems. And I think what's going on, this is totally my speculation, just the strong impression I got reading between the lines in that interview, when those lines weren't being interrupted by CNBC hosts, was it felt to me like Ray has decided that he has made a fortune in financial markets, and it's time for him to redeem himself and give something back by raising the alarm bell, not on we're about to have a bigger than 2008 market event, but we're about to have a bigger than 2008 social event, which is going to be harder for working class people. And I think Ray is very sincerely concerned about that. I wish that his people would accept our interview invitations. We've been trying to get him on the program for a long time. I guess we're just a podcast, and it's true, we're just a podcast. We would let Ray finish his sentences on this podcast, something he doesn't get the chance to do on TV. He tried to tell people, Patrick, at least 3 or 4 times, if you just read the first 60 pages of his book, and I think he knows it's a 500-page book, some people are going to be intimidated by it. He said, if you just read the first 60 pages, what you're going to get out of it is, he tried 4 times to say that, and they cut him off every time. So I still don't know what I'm going to get out of reading the first 60 pages, but I plan to read it in order to find out.
Well, Eric, I also watched the video, and I did actually have the opportunity to read the first 60 pages. And so I really took a lot away from it. And I actually thought that what best way to plug this to our listeners is give a couple excerpts that I thought were really meaningful in the book, kind of inspire everyone to pick it up and read it. So on page 19, Ray Dalio is talking about the role of monetary policy. And he goes on to say, this is one of the biggest problems with most central bank policies, because central banks target either inflation or inflation and growth and don't target the management of the bubbles. The debt growth that they enable can go on and finance the creation of bubbles if inflation and real growth don't appear to be strong. What's interesting is that it's asking the question, are central banks actually targeting the right thing by targeting inflation directly, and rather than targeting actual bubbles and asset and debt bubbles? And he's asking that question, is that have a congressional mandate given the wrong goals to central banks and what they're targeting? And is that one of the reasons why these debt bubbles actually play out?
Well, I certainly agree with Ray. Unfortunately, what I fear is that, the status quo, the central banking elite and governments in general are stuck in this deficits don't matter and the national debt's not that big of a problem mentality. And it's something that's just not a big deal until the day that it blows up and bites you, and then it's too late. And I couldn't possibly agree more with Ray's view. I'm just afraid that it may fall on deaf ears, because certainly central bankers are not thinking about using monetary policy to manage the debt. I think that the view of central bankers is that it's not their problem. It's Congress's problem to worry about whether or not the national debt is out of control, and Congress, frankly, is not doing a very good job with it. So I agree with him. I just don't know what the solution is.
I couldn't agree more. So now I wanted to just touch on the next thing, which is he then gets to a part on page 20 where he talks about spotting bubbles. Like, what does a top of a debt crisis or debt cycle look like? And what he identifies, and I thought this was really interesting, he goes, in terms of what a top looks like, he goes, early on in the top, some parts of the credit system suffer, but others remain robust. So it isn't clear that the economy is weakening. So while the central bank is still raising interest rates and tightening credit, the seeds of a recession are already being sown. And he goes on to say the fastest rate of tightening typically comes 5 months prior to the top of a stock market. And I thought that was really interesting, because when we listen to Charlie McElligott, he already thinks that we've got only a few more rate hikes left and the Fed is done. And that means the fastest rate of hiking actually already happened. And so I wonder whether we're now deep into this 5-month clock that Ray Dalio seems to be referencing in this.
Well, I certainly think that it's consistent with the conversation that we had with Charlie in this interview. Charlie doesn't think it's over quite yet, but he thinks that we're getting close. And I don't know if it's a 5-month clock or what the exact number is. As you know, tops are processes, not events. But it feels to me like we're getting closer and closer to this thing finally being over.
The last thing that I wanted to touch on here was starting on page 35, which was he titles Pushing on a String. And what's interesting, he touches on the 3 forms of monetary policy that central banks can use. Obviously, the first one, the most well-known one, is the interest rates, which is the movement of raising or lowering interest rates as a way to actually stimulate the economies. But the second monetary policy approach is quantitative easing, which is the idea of buying financial assets, particularly debt assets, which is something we already experienced. But what's interesting is then he gets on to monetary policy number 3. And this is where, the idea of monetary policy number 3 is the money is more directly put into the hands of spenders instead of investors and savers. And so this is where it gets interesting, because he talks about the idea of the increase in debt finance fiscal spending, the idea of increasing the debt finance spending while Treasury isn't on the hook for that debt, not bothering to go through issuing debt and instead just giving newly printed money directly to the government to spend, then goes on printing money and doing a direct transfer to households, also known as helicopter money, something that many of our listeners may have heard before. And of course, the idea of big debt write-downs accompanied by big money creation, or the kind of a debt jubilee. And I thought it was really interesting because that's the type of monetary policy we have not yet experienced. And so we saw number 1 and 2, where we first went from just interest rate responses to now quantitative easing responses. So the question becomes, if the next debt crisis comes around, are we now in store for this next phase? And you know what? If that's the case, that's a pretty good case for the gold bulls, isn't it?
Oh, it certainly is a good case for the gold bulls, but I also think it is a huge societal story. And this is the reason I'm so frustrated that we can't get past the people that filter Ray's emails, because the interviewer in me, Patrick, is just itching to talk to Ray. And, obviously you got to ask him the question about what's going to happen in financial markets. He's a financial markets kind of guy. But I don't get the sense that that's what he really wants to talk about. I think what he really wants to talk about is those of us who work in financial markets have made a lot of money and are better off than most people in society. What's going to happen in this next crisis, and what do we owe to society in terms of making things right? Because I think that there was a lot of injustice in the way that the 2008 event was handled. Yes, Bernanke pulled a rabbit out of a hat, managed to save the markets, but folks on Main Street didn't fare as well as the folks on Wall Street. And from what Ray said on CNBC, I think he's very concerned that the folks on Main Street are going to be much worse off in the next crisis that comes about. And it's just overwhelmingly clear to me that he has very strong feelings about that, and I would love to do a feature interview. So if we have any listeners who have access to Ray Dalio, please reach out to him. The folks who screen his emails for him have been extremely polite. They respond to us politely and decline our interview requests. And, it certainly is understandable. Ray is one of the most famous people in the entire industry. It's no surprise that if they've never heard of a podcast and he's only got time for TV appearances, that's their position. I really wish that we could get through to Ray, and perhaps the way to do that is to promise him that we really would let him finish his sentences and say what's on his mind, and not be interrupted every time he tries to tell us what to expect if we read the first 60 pages of his book, which I'm looking forward to doing this weekend. And on that note, we need to wrap it there, folks. We really appreciate your support, particularly with helping us to promote Macrovoices. So please tell your friends and colleagues about Macrovoices, and most importantly, if you haven't yet, go to macrovoices.com, register your free account. Won't cost you a thing. We won't spam you or sell your email address. The benefit to you is you'll receive our free Research Roundup email each week, which never contains any advertising or marketing. It's just a compendium of links to all of the best free content we could find on the internet each week. Patrick, tell them what they can expect to find in this week's Research Roundup.
So this week, you're going to find the transcript for today's interview. You'll also find that link to the chart book that accompanies Charlie's interview. You'll also find the link to download Ray Dalio's free debt crisis book that we just talked about. There's also a link to Kevin Muir's, the Macro Tour's most recent blog, which talks about the big bond short illusion. And what's interesting is he shed some light on the flaws of how the COT reports are actually compiled. It was a really interesting read. So you'll find this and so much more in this week's Research Roundup. So that does it for this week's episode. We appreciate all the feedback and support we get from our listeners, and we're always looking for suggestions on how we can make the program even better. Now, for those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com or tag it with the MVRR hashtag on Twitter, and we'll include it in our weekly distributions. Now, if you have not already, follow our main Twitter account at Macrovoices for all the most recent updates and releases. You can also follow Erik on Twitter at Erik S. Townsend and myself at Patrick Ceresna. On behalf of Erik Townsend and myself, thank you for listening, and we'll see you all next week.
That concludes this edition of Macrovoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. Macrovoices is made possible by sponsorship from BigPictureTrading.com. the Internet's premier source of online education for traders. Please visit bigpicturetrading.com for more information. Please register your free account at macrovoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the Internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to Macrovoices on iTunes to have Macrovoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. Macrovoices is presented for informational and entertainment purposes only. The information presented on Macrovoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Macrovoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. Macrovoices, its producers, sponsors, and hosts Erik Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on Macrovoices. Macrovoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit macrovoices.com.